For years, the world's largest banks operated with significant autonomy in measuring their own risk. Under the dual stack calculation, these institutions used bespoke internal models to determine their capital requirements, effectively grading their own homework to decide how much cash to keep in reserve. That autonomy disintegrated on March 19, 2026. Federal banking regulators issued a coordinated package of 3 proposed rules designed to dismantle the existing framework. For Category 1 and 2 institutions, the nation's largest and most complex banks, the dual stack calculation is officially dead. In its place is the Expanded Risk-Based Approach, or ERBA. This mandatory framework removes internal modeling discretion, replacing custom math with a standardized, rigid set of federal rules. Top-tier banks have lost the ability to define their own risk. The math is now controlled entirely by the regulators. This shift extends far beyond the giants. Category 3 and 4 regional banks are now facing a new requirement that brings daily market volatility directly onto their balance sheets. This bar chart shows a bank's total capital reserves. Mid-tier banks must now capitalize Accumulated Other Comprehensive Income, or AOCI, the unrealized gains and losses on securities. If interest rates spike and bond values dip, this layer contracts instantly. The bank's capital takes a direct hit before a single loan defaults. For years, regional banks used an opt-out filter to ignore these paper losses. The new rules completely eliminate that filter, exposing the fragile balance sheet to the full force of market fluctuations. Capital adequacy for mid-tier institutions is now tied directly to the real-time volatility of the bond market. The decades-long era of the flat 50% risk weight for residential mortgages has officially come to an end. This grid plots the new reality: risk weights determined by granular loan-to-value, or LTV bands. As loan amounts increase relative to property value, the required capital scales upward. A secondary multiplier applies if repayment depends on property cash flows, pushing capital requirements even higher. To manage these ratios, banks must now maintain pristine loan-level data and track borrower credit quality with total precision. Mortgage desks must now function as high-velocity data hubs, where a missing LTV data point or a stale credit score instantly raises the cost of every new loan on the books. Operational risk is undergoing a similar transition, as regulators have completely eliminated the advanced measurement approach. This is replaced by the Business Indicator Component, or BIC, a new standardized proxy for operational risk. Powered strictly by 3-year rolling financial averages, managers are locked into this calculation, leaving no modeling room to argue their internal processes are safer. This data-heavy approach extends to counterparty risk, where banks must categorize every derivative transaction as either settled to market or collateralized to market to receive any capital relief. In every risk category, the message is clear: broad estimates are finished. Flawless cross-platform data aggregation is the only way to satisfy the new math. Today, in the wake of these sweeping new regulations, every capital risk manager faces a critical strategic fork in the road. The first path is reactive, cutting operational costs and shrinking the core balance sheet to maintain ratios. The second path is proactive, investing in data lineage and robust volatility budgets to absorb real-time market swings. Banks with high-fidelity data lineage can identify exactly where capital is trapped in inefficient risk-weight bands. While unprepared peers freeze their lending, these banks can deploy their freed-up capital into the highest yield opportunities. Reducing assets to meet capital ratios creates a vicious cycle of diminishing returns. By shrinking the core to save on capital, a bank loses the revenue needed to fund the data systems required to navigate the next market shift. The simple compliance shield is over. Meeting basic regulatory deadlines won't protect your institution's market position. A check-the-box approach fails the moment an AOCI volatility spike hits the balance sheet. Executive success now hinges on proving the logic behind a capital allocation, even as the underlying data points remain in constant flux. Leaders must now be completely able to defend their capital strategies dynamically, demonstrating absolute resilience to the market before the next volatility cycle begins.